To estimate the value of a stock, I built this tool. You search for a company like Apple, and the tool automatically fills some financial data from FinViz and Yahoo Finance. You should still double check the numbers to make sure the data is correct. Then you enter your estimate of how fast you think the company will grow in the next 5 years and how fast it may grow from year 5 to year 10. After that, you choose the return you want as an investor. The higher the return rate, the more conservative the valuation becomes. I usually use 10 to 15% because I personally want a 10 to 15% annual return. The tool then performs a discounted cash flow calculation. Basically, the money in the future is worth less than the money today. So the future earnings are discounted using the return rate you selected. You also choose the terminal multiple, in simple terms, after 10 years. How many times earnings would investors value this company? Maybe 20, like the S&P 500 average, maybe 30 if the company is growing faster, or maybe 10 if the growth slows down. Then you fill this for 3 different scenarios. A normal case, a very optimistic best case, and a worst case scenario. At the end, you assign a probability to each case. You might think the normal case has a 60% probability, the best case 30%, and worst 10%. Then the tool gives you a probability weighted value for the stock. You compare this value with the current market price to decide whether the stock looks undervalued or overvalued. I hope it's helpful, and let me know in the comments what changes can I do to make it even more useful for you.